My name is Michael Mullen from Omaha. Would you comment on the use of derivatives? I noticed Dell Computer stock was off 2.5 points Friday with the loss in derivatives.
The question is about derivatives. We have in this room the author of the best thing you can read on that. There was an article in Fortune about a month ago or so by Carol Loomis on derivatives, and far and away is the best article that's been written. We also have some people in the room that do business in derivatives from Solomon, and it's a very broad subject. As we said last year, I think someone asked what might be the big financial story of the 90s, and we said we obviously don't know, but that if we had to pick a topic, that it could well be derivatives, because they lend themselves to the use of unusual amounts of leverage, and they are sometimes not completely understood by the people involved. And anytime you combine ignorance and borrowed money, you can get some pretty interesting consequences, and particularly when the numbers get big. And you've seen that, of course, recently with the recent Procter & Gamble announcement. Now, I don't know the details of the P&G derivatives, but I understand, at least from that what started out as interest rate swaps ended up with P&G writing puts on large quantities of U.S. and I think one other country's bonds. And anytime you go from selling soap to writing puts on bonds, you've made a big jump. And the ability to borrow enormous amounts of money, combined with the chance to get either very rich or very poor very quickly, has historically been a recipe for trouble at some point. And derivatives are not going to go away. They serve useful purposes and all of that, but I'm just saying that it has that potential. And we've seen a little bit of that. I can't think of anything that we've done that would... Do you think of anything we do that approaches derivatives, Charlie? Directly?
No.
No. I may have to cut him off if he talks too long. Is there anything you would like to add to your already extensive remarks? I'm sorry.
No.
Okay. In that case, we'll go to zone 2.
Good morning. My name's Howard Bascom. I'm from Kansas City, and I've got a theoretical value question for you. If you were to buy a business and you bought it at its intrinsic value, what's the minimum after-tax free cash flow yield you'd need to get?
Well, your question is, if we were buying all of a business and we were buying it at what we thought was intrinsic value, what was the minimum?
Correct.
Present earning power, or what the minimum discount rate of future streams?
No, what's the minimum current after-tax free cash flow yield you'd need to get?
We could conceivably buy a business. I don't think we would be likely to, but we could conceivably buy a business that had no current after-tax cash flow, but we would have to think it had a tremendous future. But we would not find, obviously, the current figures, particularly in the kind of businesses we buy, tend to be representative, we think, of what's going to happen in the future. But that would not necessarily have to be the case. You can argue, for example, in buying stock at a time when it was losing significant money. We didn't expect it to continue to lose significant money, but if we think the present value of the future earning power is attractive enough compared to the purchase price, we would not be overwhelmed by what the first year's figure would be. Charlie, you want to add to that?
Yeah, well, we don't care what we report in the first year or two of after buying anything.
Well, I would say that in a world of 7% long-term bond rates, that we would certainly want to think we were discounting future after-tax streams of cash at least a 10% rate. But that will depend on the certainty we feel about the business. The more certain that we feel about a business, the closer we're willing to play it. We have to feel pretty certain about any business before we're even interested at all. But there's still degrees of certainty. And if we thought we were getting a stream of cash over the next 30 years that we felt extremely certain about, we would use a discount rate that would be somewhat less than if it was one where we thought we might get some surprises in 5 or 10 years. The possibility existed. Charlie?
Nothing to add.
Okay. Zone 4.
Is there any point at which your stock would rise to the point where you might split the stock?
Surprise, surprise. I think I'll let Charlie answer that this year. He's so popular with the shareholders that I can afford to let him take the tough questions.
I think the answer is no. I think the idea of carving ownerships in an enterprise into little tiny $20 pieces is almost insane. I mean, it's quite inefficient to service a $20 account, and I don't see why there shouldn't be a minimum as a condition of joining some enterprise. Certainly, we'd all feel that way in a private enterprise.
Yeah, we would not carve it up in $20 units. We find it very, it's interesting because every company finds a way to fill up its common shareholder list, and you can start with the A's and work through to the Z's, and every company in the New York Stock Exchange, one way or another, has attracted some constituency of shareholders. And frankly, we can't imagine a better constituency than is in this room. I mean, we don't think we can improve on this group, and we followed certain policies that we think attracted certain types of shareholders and actually pushed away others, and that is part of our eugenics program here at Berkshire.
Yeah, just look around this room, and as you mingle with one another, this is a very outstanding group of people, and why would anybody want a different kind of a group?
Yeah, if we follow some policies that cause a whole bunch of people to buy Berkshire for the wrong reason, the only way they can buy it is to replace somebody in this room or in this larger metaphorical room of shareholders that we have. So someone in one of these seats gets up and somebody else walks in. The question is, do we have a better audience? I don't think so. So I think Charlie said it very well.
Mr. Buffett, my name's Alan Maxwell from Omaha. I've got 2 questions. What is your next goal in life now that you're the richest man in the country?
That's easy. It's to be the oldest man in the country.
Secondly, you talk about good management with corporations and that you try and buy companies with good management. I feel that I have about as much chance of meeting good managers other than yourself as I do bringing Richard Nixon back to life. How do I, as an average investor, find out what good management is?
Well, I think you judge management by 2 yardsticks. One is how well they run the business, and I think you can learn a lot about that by reading about both what they've accomplished and what their competitors have accomplished, and seeing how they have allocated capital over time. You have to have some understanding of the hand they were dealt when they themselves got a chance to play the hand. But if you understand something about the business they're in, and you can't understand it in every business, but you can find industries or companies where you can't understand it, then you simply want to look at how well they have been doing in playing the hand essentially that's been dealt with them. And then the second thing you want to figure out is how well that they treat their owners. And I think you can get a handle on that oftentimes. A lot of times you can't. I mean, there are many companies that obviously fall in somewhere in that 20th to 80th percentile, and it's a little hard to pick out where they do fall. But I think you can usually figure out, I mean, it's not hard to figure out that, say, Bill Gates or Tom Murphy or Don Keogh or people like that are really outstanding managers. And it's hard to figure out who they're working for. And I could give you some cases on the other end of the spectrum, too. It's interesting how often the ones that, in my view, are the poor managers also turn out to be the ones that really don't think that much about the shareholders, too. The two often go hand in hand. But I think reading of reports, reading of competitors' reports, I think you'll get a fix on that in some cases. You don't have to, you don't have to make 100 correct judgments in this business or 50 correct judgments. You only have to make a few. And that's all we try to do. And generally speaking, the conclusions I've come to about managers have really come about the same way you could make yours. I mean, they've come about by reading reports rather than any intimate personal knowledge or knowing them personally at all. So read the proxy statements, see what they think of, see how they treat themselves versus how they treat the shareholders, and look at what they have accomplished considering what the hand was that they were dealt when they took over, compared to what is going on in the industry. And I think you can figure it out sometimes. You don't have to figure it out very often. Charlie?
Nothing to add.
No.
Hi there. My name is Lee. I'm from Palo Alto, California. In meeting Ajit Jain, I've been very impressed over the years. I think I even met his parents once. They came from India. Please comment on your deepest impressions of his personality and managerial skills, and also how you go about exactly keeping somebody with such fine skills within the fold. He might go to Walt Disney someday and pull down $200 million.
Well, if he gets offered $200 million, we may not compete too vigorously at that level. We basically try to run a business so that Charlie and I have two jobs. We have to identify and keep good managers interested after we figured out who they are, and that often is a little different here because I would say a majority of our managers are financially independent, so that they don't go to work because they are worried about putting kids through school or putting food on the table. So they have to have some reason to go to work aside from that. They have to be treated fairly in terms of compensation, but they also have to figure it is better than playing golf every day or whatever it may be. And so that's one of the jobs we have, and we basically attack that the same way. We look at what they do the same way we look at what we do. We've got a wonderful group of shareholders. Before I ran this, I had a partnership. I had a great group of partners, and essentially I like to be left alone to do what I did. I like to be judged on the scorecard at the end of the year rather than on every stroke, and not second-guessed in a way that was inappropriate. I like to have people who understood the environment in which I was operating. And so the important thing we do with managers generally is to find the 400 hitters and then not tell them how to swing, as I put in the report. Second thing we do is allocate capital. And aside from that, we play bridge. It's pretty much what happens at Berkshire. So with any of the managers you might name here, we try to make it interesting and fun for them to run their business. We try to have a compensation arrangement that's appropriate for the kind of business they're in. We have no company-wide compensation plan. We wouldn't dream of having some compensation expert or consultant come in and screw it up. We try to, some businesses require a lot of capital that we're in, some require no capital. Some are easy businesses where good profit margins are a cinch to come by, but we're really paying for the extra beyond that. Some are very tough businesses to make money in. And it would be crazy to have some huge framework that we tried to place everybody in that where one size would fit all. people generally are compensated relating in some manner that relates to how their business does, as opposed to there's no reason to pay anybody based on how Berkshire does, because no one has responsibility for Berkshire except for Charlie and me. And we try to make them responsible for their own units, compensated based on how those units do. We try to understand the businesses they're in, so we know what the difference between a good performance and a bad performance. And that's how we work with people. We've had terrific luck over the years in retaining the managers that we wanted to retain, and it's I think largely it's because, particularly, they sell us a business that to a great extent the next day they're running it just as they were the day before, and they're having as much fun running their business as I have running Berkshire. Charlie?
Well, I've got nothing to add, but I think it's that concept of treating the other fellow the way you'd like to be treated if the roles were reversed. It's so simple when you stop to think about it, but it's a rare evening when Ajit and Warren aren't talking once on the phone. It's more than a business relationship. At least it seems that way to me.
Yeah, well, it is. Stay that way, too.
And by the way, we like our relationships to be more than a business relationship.
Charlie and I are very far. We basically, it's a luxury, but it's a luxury that we should try to nurture. We get to work with people we like, and it makes life a lot simpler. It probably helps on that goal of being the oldest living American, too.
Yeah, and we tend to like people we admire.
Yeah, who do we like that we don't admire, Charlie? Start naming names. Do these people have names? Zone 2.
Mr. Buffett, my name is Arthur Collius from Canton, Massachusetts, and I'd like to know how you respond to the question that my associates asked me when they say that Berkshire Hathaway has been a good investment up to now, but if, God forbid, something happens to Mr. Warren Buffett.
Well, I'm glad you didn't say Charlie Munger. Now, Berkshire will do just fine. We've got a wonderful group of businesses. I've told you the two things I do in life, and in terms of the managers we have, you'd have to come in and really want to mess it up, I would think. And we don't have anybody like that in terms of succession plans at Berkshire. And then there's the question of allocation of capital, and you could do worse than just adding it to some of the positions that we already had. The ownership, if I die tonight, the ownership structure does not change. So you've got the same large block of stock that has every interest in having good successor management as I would. I mean, there would be no greater interest, and it's not a complicated business. I mean, you ought to worry more about, if you own Microsoft, about Bill Gates, I think, or something of the sort. But this place is, we've got a group down here that are running these. You didn't see me out at Berkshire. I'm selling any jewelry the other day. I mean, that's somebody else's job. So it's not very complicated. Incidentally, I think I'm in pretty good health. I mean, this stuff will do wonders for you if you'll just try it. Charlie, do you want to add anything?
Yeah, I think the prospects of Berkshire would be diminished, obviously diminished, if Warren were to drop off tomorrow morning. But it would still be one hell of a company, and I think it would still do quite well. I used to do legal work when I was young for Charlie Skouras. I heard him once say, my business, which was movie theaters like this one, was off 25% last year, and last year was off 25% from the year before, and that was off 25% from the year before. And then he pounded the table and he'd say, but it's still one hell of a business.
It's not a formula we want to test,
No.
It is one hell of a business, though, we've got here. I mean, if you saw what happened at Berkshire headquarters, you would not worry as much. There's very little going on there that contributes to things. We're right now at our peak of activity. This is it. Zone 4.
Mr. Buffett, I'm Lee Miller from St. Louis. There was an article in the April 18th Barron's that attempted to calculate the value behind each Berkshire Hathaway share. I'm sure you have some views on that, and I'd be very interested in your perspective on that issue.
Yeah, there was an article about a week or so ago in Barron's. The same fellow wrote an article about 4 years ago reaching pretty much the same conclusion, and I hope he hasn't been short in between, but I would say this, it is not the way I would calculate the intrinsic value of Berkshire, but everyone in securities markets makes choices on that. Every day somebody sells a few shares of Berkshire and someone buys, and they are probably coming to differing opinions about valuation. I would say that I found it strange that apparently he forgot we were in the insurance business, but that's not total. It really doesn't make any difference. I mean, we don't pay any attention to what people say about Coca-Cola stock or Gillette stock or any of those things. I mean, on any given day, 2 million shares of Coca-Cola may trade. That's a lot of people selling, a lot of people buying it. If you talk to one person, you'd hear one thing, and talk to another. You really should not make decisions in securities based on what other people think. If you're doing that, you should think about doing something else, because a public opinion poll will not get you rich in Wall Street. So you really want to stick with businesses that you feel you can somehow evaluate yourself. And Charlie and I, we don't read anything about what the economy is going to do, or the market's going to do, or what anytime I see some article that says, these analysts say this or that about some business, it doesn't mean anything to us. You cannot get rich with a weather vane. Zone 7.
Mr. Buffett, my name is Bill Ackman. I'm from New York City, and my question relates to the appeal of Salomon Brothers as an investment. You talked earlier about leverage and the dangers of leverage. Salomon is a business which is levered 30-to-1, which has very narrow margins and earns a relatively modest return on equity in light of the amount of leverage that they use. What is the appeal of the business to you?
We have here today the chief executive of Salomon Inc., the parent company, and also the chief executive of Salomon Brothers, the investment banking arm. And I would say one of the things Charlie and I feel extraordinarily good about are the two fellows that are running that operation. They did an exceptional job under extraordinarily difficult circumstances, as did John McFarlane, who's also here today. The three of them, I mentioned 4 people in the annual report, and Salomon wouldn't be here today without those three, and it wouldn't be the company in the future that it's going to be without them. And they did an absolutely fabulous job. It's the sort of business that, as you point out, uses a lot of leverage. It doesn't, in one way, it doesn't use as much as it looks like, in another way, it uses even more than it looks like. But the test will be, A, whether they control that business in a way that leverage does not prove dangerous, and secondly, what kind of returns on equity they earn while using it. You certainly should expect to earn somewhat higher returns on equity when you are necessarily exposed to a small amount of systemic risk and significant amounts of borrowed money than you would in a business that's an extremely plain vanilla business. But I don't know whether you've met Bob and Derek, but I think you'd feel better about having leverage in their hands than about any other hands you can imagine. Charlie?
Why don't we have those 3 gentlemen stand up?
Yeah, you ought to give them a hand.
They really have done a job for Berkshire in this last year.
I'll lead the applause for them. Where are they? There they are.
Given the scrutiny that the tobacco business is going under right now, Number one, what do you see as the business prospects for those huge cash cows? And at any point, would that be attractive to you given their liability?
Questions about the future of the tobacco business? I probably know more about that than you do, because it's fraught with questions that relate to societal attitudes, and you can form an opinion on that just as well as I could. But I would not like to have a significant percentage of my net worth in the tobacco business myself. But they may have better futures than I envision. I don't really think that I have special insights on that. Charlie, you?
No.
You have to come to a conclusion as to how society is going to want to treat, and the present administration for that matter. The economics of the business may be fine, but that doesn't mean it has a great future.
Clayton Riley from Jacksonville, Florida. This is a little different than all the other questions, but what were the three best books you read last year outside of the investment field? Even one will do.
I'll give you. I'll tout a book first that I've read, but that isn't available yet. But it will be in September. The woman who wrote it, I believe, is in the audience, and it's Ben Graham's biography, which will be available in September by Janet Lowe, and I've read it, and I think those of you who are interested in investments for sure will enjoy it. She's done a good job of capturing Ben. One of the books I enjoyed a lot was written also by a shareholder who's not here, because he's being sworn in, I believe today or tomorrow, maybe tomorrow, as head of the Voice of America, and that's Jeff Cowan's book, which is on the People versus Clarence Darrow. It's the story of the Clarence Darrow trial for essentially jury bribery in Los Angeles back around 1912, when the McNamara brothers had bombed the L.A. Times. And it's a fascinating book. Jeff uncovered a lot of information that the previous biographies of Darrow didn't have. I think you'd enjoy that. Charlie? Again?
Well, I very much enjoyed Connie Bruck's biography, Master of the Game, which was a biography of Steve Ross, who headed Warner and later was, co-chairman of Time Warner.
Yeah, a little more than co-chairman.
Yeah, and she's a very insightful writer, and it's a very interesting story. I am rereading a book I really like, which is Van Dorn's biography of Benjamin Franklin, which came out in 1952. And I'd almost forgotten how good a book it was. And that's available in paperback everywhere. And we've never had anybody quite like Franklin in this country. Never again.
He believed in compound interest too, incidentally, as you may remember. We set up those two little funds, one in Philadelphia and one in Boston.
Right.
Yeah, to demonstrate the advantages of compound interest. I think that's the part Charlie's rereading. Zone 2.
My name is Mike Assail from New York City. You mentioned earlier that Berkshire's shoe business was great, but that other shoe businesses were not so good. What are the uncertainties of the global brand leaders that the Berkshire seems to like? They like Coke and Gillette. The global brand leaders in the shoe business being Nike and Reebok. What are their uncertainties in terms of long-term competitive advantage, business economics, consumer behavior, and the other risk factors that you mentioned in the annual report this year? Thank you.
So you're really asking about the future prospects of Nike and Reebok? Yeah, I don't know that much about those businesses. We do have one person in this audience at least who owns a lot of Reebok, but I'm not expressing a negative view in any way on that. I don't understand that. I don't understand their competitive position and the likelihood of permanence of their competitive position over a 10 or 20-year period, as well as I think I understand the position of Brown and Dexter. That doesn't mean I think that it's inferior. It doesn't mean that I think that we've got better businesses or anything. I think we've got very good businesses, but I haven't done the work, and I'm not sure if I did the work I would understand them. I think they are harder to understand, frankly, and to develop a fix on than our kinds. But they may be easier for other people who just have a better insight into that kind of business. Some businesses are a lot easier to understand than others. And Charlie and I don't like difficult problems. I mean, if something is hard to figure, you know, I mean, we'd rather multiply by 3 than by pi. I mean, it's just easier for us. You don't have to do, we've said this before, but you don't have to do exceptional things to get exceptional results. And some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all. So you can do very ordinary things. I mean, what is complicated about this? But, you know, we're $3 billion pre-tax better off than we were a few years ago because of it. There's nothing that I know about that product or its distribution system, its finances, or anything that really hundreds of thousands or millions of people aren't capable of, that they don't already know. They just don't do anything about it. And similarly, if you get into some complicated business, you can get a report that's 1,000 pages thick, and you got PhDs working on it, but it doesn't mean anything. You know, what you've got is a report, but you won't understand that business, what it's going to look like in 10 or 15 years. The big thing to do is avoid being wrong.
There's some things that are so intrinsically dangerous. Another of my heroes is Mark Twain, who looked at the promoters of his day, and he said, "A mine is a hole in the ground owned by a liar." And that's the way I've come to look at projections. I mean, basically, I can remember Warren and I were offered $2 million worth of projections once in the course of buying a business, and the book was this thick, and
for nothing.
And we were given it for nothing, and we wouldn't open it.
You know, we'd almost pay $2 million not to look at it. I mean, it's ridiculous. I do not understand why any buyer of a business looks at a bunch of projections put together by a seller or
his agent.
Or his agent. I mean, you can almost say that it's naive to think that that has any utility whatsoever. We just are not interested. If we don't have some idea ourselves of what we think the future is, to sit there and listen to some other guy who's trying to sell us the business or get a commission on it tell us what the future is going to be, like I say, it's very naive.
Yeah, and 5 years out.
Yeah. We had a line in the report one time, "Don't ask the barber whether you need a haircut." And it's quite applicable to projections by sellers of businesses. Zone 3.
My name is Sheldon Zizek from Chicago, Illinois. I have 2 questions. The first one is concerning Mr. Munger. We know what Mr. Buffett's retirement plans are. I was wondering what your plans for the future concerning Berkshire are.
I've always preferred the system of retirement where you can't quite tell from observing from the outside whether the man is working or retired.
He does it well, too.
You know, a problem in many businesses, particularly the more bureaucratic ones, is that your employees retire, but they don't tell you. And
I think I can speak for Charlie on this. Charlie and I are not in any hurry to retire. He's trying to outlast me, actually.
Mr. Buffett, Kathleen Ambrose from Omaha. I have a question regarding global diversification, just in general. What do you look for in a company? And if so, as far as Europe or Latin America, if you'd like to be specific.
Yeah. The question is about global diversification. All we want to be in is businesses that we understand, run by people that we like, and priced attractively compared to the future prospects. So there is no specific desire to either be in the rest Europe or the rest of the world or Far East, or to avoid it. It's simply a factor that it's not a big factor. There may be more chances for growth in some countries. 80% of Coca-Cola's earnings, roughly, will come from outside the United States. 80% of Guinness's earnings will come from outside the United States, but they're domiciled outside the United States, whereas Coca-Cola is domiciled here. Certainly, in many cases, there are markets outside the United States that have way better prospects for growth than the U.S. market would have, but they probably have some other risks to them that this market may not have. But we like the international prospects, obviously, of a company like Coke. We like the international prospects of a company like Gillette. Gillette earns 70% of its money outside this country. So if you look on a look-through basis, Coke, we might this year get something like $150 million of earnings indirectly for Berkshire's interest from the rest of the world just through Coca-Cola alone. But we don't make any specific, we don't think in terms of, I like this region so I want to be there or something of the sort. It's something that's specific to the companies we were looking at, and then we'll try to evaluate that. Coke is expanding in China. Well, I think, I forget what they showed last year, maybe 38% growth or something like that in cases. It's nice to have markets like that are relatively untapped. Actually, Gillette is expanding in China in a big way, and the Chinese don't shave as often, and more of them are what they call dry shavers than wet shavers there, which is electric shavers. But maybe we could stick something into Coke that would come. Maybe a little synergy at Berkshire finally. Who knows? Zone 1.
Diane West from Corona Del Mar, California. I know, Mr. Buffett, that you've said that you don't read what other people say about the market or the economy, but do either you or Charlie have an opinion about how you think things are going to go? Are you bullish or bearish?
You may have trouble believing this, but Charlie and I never have an opinion about the market because it wouldn't be any good, and it might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that because we thought something about what the market was going to do or anything of that sort, because we just don't know. And to give up something that you do know and that is profitable for something that you don't know and won't know because of that, it doesn't make any sense to us, and it doesn't really make any difference to us. I mean, I bought my first stock, I think, in probably April of 1942 when I was 11. And since then, I mean, actually, World War II didn't look so good at that time. I mean, the prospects, they really didn't. I mean, we were not doing well in the Pacific, and I'm not sure I calculated that into my purchase of my 3 shares. But I mean, just think of all the things that have happened since then, atomic weapons and major wars and presidents resigning and all kinds of things, massive inflation at certain times. To give up what you're doing well because of guesses about what's going to happen in some macro way just doesn't make any sense to us. The best thing that can happen from Berkshire's standpoint, we don't wish this on anybody, but over time, is to have markets that go down a tremendous amount. I mean, we are going to be buyers of things over time. Now, if you're going to be buyers of groceries over time, you like grocery prices to go down. If you're going to be buying cars over time, you like car prices to go down. We buy businesses. We buy pieces of businesses, stocks. And we're going to be much better off if we can buy those things at an attractive price than if we can't. So we don't have any fear at all. I mean, what we fear is an irrational bull market that's sustained for some long period of time. You, as shareholders of Berkshire, unless you own your shares on borrowed money or are going to sell them in a very short period of time, are better off if stocks get cheaper, because it means that we can be doing more intelligent things on your behalf than would be the case otherwise. But we have no idea and we wouldn't care what anybody thought about it. I mean, most of all ourselves. I mean, Charlie, do you have any?
No, I think if you're agnostic about those macro factors and therefore devote all your time to thinking about the individual businesses and the individual opportunities, it's a way more efficient way to behave, at least with our particular talents and lacks thereof.
If you write about the businesses, you'll end up doing fine. We don't know, and we don't think about when something will happen. We think about what will happen. It's not so difficult to figure out what will happen. It's impossible, in our view, to figure out when it will happen. So we focus on what will happen. This company in 1890 or thereabouts, the whole company sold for $2,000. It's got a market value now of about 50-odd billion. You know. Somebody could have said to the fellow who was buying this in 1890, you know, you're going to have a couple of great world wars, and you know, you'll have the panic of 1907. All these things will happen. And wouldn't it be a better idea to wait? You know? We can't afford that mistake, basically. Yeah. Zone 3.
Hello. My name is Charles Pyle from Ann Arbor, Michigan. I'd like to ask you to expound on your view of risk in the financial world. And I ask that against the background of what appear to be a number of inconsistencies between your view of risk and the conventional view of risk. I mentioned that in a recent article you pointed out an inconsistency in the use of beta as a measure of risk, which is a common standard. And I mentioned that derivatives are dangerous, and yet you feel comfortable playing in derivatives through Salomon Brothers, and betting on hurricanes is dangerous, and yet you feel comfortable playing with hurricanes through insurance companies. So it appears that you have some view of risk that's inconsistent with what would appear on the face of it to be the conventional view of risk.
Well, we do define risk as the possibility of harm or injury, and in that respect, we think it's inextricably wound up in your time horizon for holding an asset. I mean, if your risk is that if you intend to buy XYZ Corporation at 11:30 this morning and sell it out before the close today, I mean, that is, in our view, that is a very risky transaction, because we think 50% of the time you're going to suffer some harm or injury. If you have a time horizon on a business, we think the risk of buying something like Coca-Cola at the price we bought it at a few years ago is so close to nil in terms of our prospective holding period. But if you ask me the risk of buying Coca-Cola this morning and you're going to sell it tomorrow morning, I say that's a very risky transaction. Now, as I pointed out in the annual report, it became very fashionable in the academic world, and then that spilled over into the financial markets, to define risk in terms of volatility, of which beta became a measure. But that is no measure of risk to us. The risk in terms of our super cat business is not that we lose money in any given year. We know we're going to lose money in some given day, that is for certain, and we're extremely likely to lose money in a given year. Our time horizon of writing that business would be at least a decade, and we think the probability of losing money over a decade is low. So we feel that in terms of our horizon of investment, that is not a risky business, and it's a whole lot less risky than writing something that's much more predictable. Interesting thing is that using conventional measures of risk, something whose return varies from year to year between plus 20% and plus 80% is riskier as defined than something whose return is 5% a year every year. We just think the financial world has gone haywire in terms of measures of risk. We look at what we do. We are perfectly willing to lose money on a given transaction, arbitrage being an example, any given insurance policy being another example. We are perfectly willing to lose money on any given transaction. We are not willing to enter into transactions in which we think the probability of doing a number of mutually independent events but of a similar type has an expectancy of loss. And we hope that we are entering into our transactions where our calculations of those probabilities have validity. And to do so, we try to narrow it down. There are a whole bunch of things we just won't do because we don't think we can write the equation on them. But we basically, Charlie and I, by nature, are pretty risk averse, but we are very willing to enter into transactions. If we knew it was an honest coin and someone wanted to give us 7 to 5 or something of the sort on one flip, how much of Berkshire's net worth would we put on that flip? Well, it would sound like a big number to you. It would not be a huge percentage of the net worth, but it would be a significant number. We will do things when probabilities favor us. Charlie?
Yeah, I would say we try and think like Fermat and Pascal as if they'd never heard of modern finance theory. I really think that a lot of modern finance theory can only be described as disgusting.
The question about Berkshire being I think it was a rich man's mutual fund or something like that, we don't look at it that way at all. We look at it as a collection of businesses, and ideally we would own all of those businesses. So it's to the extent that a mutual fund owns stock in a lot of companies and diversifies among businesses, and we try to own a lot of businesses ourselves. I guess that's true, but I guess you could say the same thing of General Electric or an operation like that. We are more prone to buy pieces of businesses than the typical manager, but we are trying to do, in a sense, the same thing Jack Welch is trying to do at General Electric, which is try to own a number of first-class businesses. He gets to put the imprint of his own management, which I think is very good, on those businesses, and we are more hands-off both in the businesses we own outright and in the ones we own pieces of. But we're going at it the same way, and General Electric has been very successful under Jack's leadership in doing it his way. We think in terms of what we bring to the game and the problems of putting money to work all the time that our own system is, will work best for us. Charlie?
Yeah, I've got nothing to add to that.
Zone 1.
Hello, I'm Christopher Davis from New York City. I'm interested in that many of the holdings of Berkshire are in industries that are perceived as interest rate sensitive industries, including Wells Fargo, Solomon, Freddie Mac, even Geico. And yet you have an admitted sort of ambivalence towards interest rates or changes in interest rates, and it therefore seems that you don't feel that those changes affect the fundamental attractiveness of those businesses. I thought maybe you could share your thoughts on what you see in these businesses that the investment community as a whole is ignoring.
Well, the value of every business, the value of a farm, the value of an apartment house, the value of any economic asset is 100% sensitive to interest rates, because all you are doing in investing is transferring some money to somebody now in exchange for what you expect a stream of money to come in over a period of time. And the higher interest rates are, present value is going to be. So every business by its nature, whether it's Coca-Cola or Gillette or Wells Fargo, is in its intrinsic valuation is 100% sensitive to interest rates. Now the question as to whether a Wells Fargo or a Freddie Mac or whatever it may be, whether their business gets better or worse internally as opposed to the valuation process because of higher interest rates, that is not easy to figure. I mean, Geico, if they write their insurance business at the same underwriting ratio, in other words, they have the same loss and expense experience relative to premiums, they benefit by higher interest rates, obviously, over time because they're a float business and the float is worth more to them. Now, externally, getting back to the valuation part, the present value of those earnings also becomes less then, but the present value of Coke's earnings becomes less in a higher interest rate environment. Wells Fargo, it's whether they earn more or less money under any given interest rate scenario is hard to figure. There may be one short-term effect and there may be another long-term effect. So I do not have to have a view on interest rates, and I don't have a view on interest rates, to make a decision as to an insurance business or a mortgage guarantor business or a banking business or something of the sort relative to making a judgment about Coke or Gillette. Charlie?
I've got nothing to add.
Zone 2?
How does Berkshire Hathaway feel about times of relative financial insecurity? Do you arrange for more cash reserves looking forward to a time when you might be able to buy, or do you go along your path?
I think the question is, do we get into asset allocation by maintaining given levels of cash depending on some kind of outlook or something of the sort? We don't really think that way at all. If we have cash, it's because we haven't found anything intelligent to do with it that day in the way of buying into the kind of businesses we like. And when we can't find anything for a while, the cash piles up. But that's not through choice. That's because we're failing at what we essentially are trying to do, which is to find things to buy. And we make no attempt to guess whether cash is going to be worth more 3 months from now or 6 months from now or a year from now. So it is, you will never see, we don't have any meetings of any kind anyway at Berkshire, but we would never have an asset allocation meeting. We would keep looking. I mean, Charlie's looking, I'm looking, some of our managers are looking. We're looking for things to buy that meet our tests. And if we showed no cash or short-term securities at year-end, we would love it because it would mean that we'd found ways to employ the money in ways that we like. I think I would have to admit that if we have a lot of money around, we are a little dumber than usual. I mean, it tends to make you careless. And I would say that the best purchases are usually made when you have to sell something to raise the money to get them, because it just raises the bar a little bit that you jump over in the mental decisions. But we have, I don't know what we'll show, but certainly well over $1 billion of cash around, and that's not through choice. That is that you can look at that as an index of failure on the part of your management. And we will be happy when we can buy businesses or small pieces of businesses that use up that money. Zone 4.
Good morning. I'm Sarah Pruitt from Milwaukee, Wisconsin. And I wondered if you feel that the speed with which information is available and disseminated today has affected your business buying decision process. And do you believe that speed has caused you to miss opportunities?
Question about C's expanding?
No. Does the speed of information today affect our decision-making process?
No, I would say that we perform about like we were doing 30 or 40 years ago. I mean, we read annual reports. The speed of information really doesn't make any difference to us. It's the processing and finally coming to some judgment that actually has some utility. That is, that it's a judgment about the price of a business or a part of a business, a security, versus what it's essentially worth. And none of that involves anything to do really with quick information. It involves getting good information, but usually it's not. We're not looking for needles in haystacks or anything of the sort. You know, we like haystacks, not needles, basically, and we want it to shout at us. And I would say well, virtually everything we've done has been reading public reports and then maybe asking questions around to ascertain trade positions or product strengths or something of that sort. But we never have to. We can make decisions very fast. I mean, we get called on a business or we can make up our mind whether we're interested in 2 or 3 minutes. I mean, that takes no time. We may have to do a little checking on a few things subsequently. But we don't need to get, I can't think of anything where we really need lots of price data or things like that extremely fast to make any decisions. We've got good management information systems in our operating businesses, but that's just another, that's a question of keeping inventories where they should be and all of that sort of thing. I don't think I think you could be in some place where the mails were delayed 3 weeks and the quotations were delayed 3 weeks, and I think you could do just fine in investing. Zone 6.
Mike Macy from Indianapolis. I have really enjoyed reading your annual letters and your annual report, and I've gone back and read all the older ones too. They're terrific. I have also enjoyed reading the 2 books by Peter Lynch. And I see a lot of commonalities between the two of you, the way you think and your philosophy, etc. I'd certainly appreciate it if you'd make a few comments on what you think of Peter Lynch, the things he says in his 2 books, and the advice that he gives to investors. Thank you.
I know Peter. I don't know him well, but we played bridge together in Omaha, as a matter of fact. And I like him personally, and obviously he has an outstanding record. And he has written those 2 books which have been bestsellers about his investment philosophy. I don't really have anything. I'm not going to embroider on his. There's certainly a fair amount of overlap. There's some difference. Peter obviously likes to diversify a lot more than I do. I mean, he owns more stocks than the names of companies I can remember. I mean, but that's Peter. And I've said in investing in the past that there's more than one way to get to heaven, and that there isn't a true religion in this, but there's some very useful religions. And Peter's got one, and I think we've got one that's useful too, and there is a lot of overlap. But I would not do as well if I tried to do it the way Peter does it, and he probably wouldn't do as well if he tried to do it exactly the way I do it. I like him personally very much. He's a high-grade guy. Zone 2.
David Gottesman from New York. It's no wonder that this meeting draws stockholders from all over the country. And despite the talk about age today, I'm happy to say this meeting gets better every year. Berkshire stands unique in American business as a company whose name has become synonymous with management excellence. Unlike many American corporations, we as stockholders don't have to worry about reorganizations, large write-offs, massive restructurings, overstated earnings, and overpaid executives with strategic visions. Instead, year in and year out, we enjoy the benefits of the common sense and brilliance of Charlie and Warren.
What did you say your name was?
I want to add to that, to say nothing of your good humor. It's easy to take such consistently outstanding results for granted, but we in this room are the direct beneficiaries of their efforts. By our presence here today, we show our appreciation to them for their exceptional performance. but we can also demonstrate it in another way. I would like to suggest we give him a rousing hand of applause for a job well done. Thank you.
Thank you. That was Sandy Gottesman. We've worked together for 30 odd years, and he's finally got that down. I appreciate that, Sandy. With that, we will adjourn, and anyone who wants to stay around, we'll reconvene in 15 minutes, and then we'll be here till about 1:15. And for the rest of you, there's buses, candy, etc., world books out there. Thank you.
Lee again from Palo Alto. By Omaha standards, you are a relatively young man. And every year, you point out that Berkshire's size now precludes you from making the great, relatively small trades which made your reputation. How much thought have you given to breaking up Berkshire into smaller entities?
How much what?
How much thought have you given into breaking up Berkshire into smaller entities which would allow you to make those nice, small, wonderful trades that you made from the beginning?
It wouldn't do any good to break into smaller entities because I'd still own, we'd still have 10 billion plus of capital to be responsible for wherever it would be. So we could distribute it out to the shareholders and let them make their own decisions, obviously. And anytime we thought that we weren't going to get more than $1 of value per dollar retained, that obviously would be the course to follow. But there's no magic to creating multiple little. I mean, we could call Berkshire 2, Berkshire 3 $1 billion to invest, and it doesn't really solve anything. Charlie, do you have any thoughts on that?
No, Berkshire is incredibly decentralized in terms of power and decisions resting in the operating divisions. In terms of the marketable securities, it's incredibly centralized. And so far, we have not had any big penalty from not being able to do the things that we did when we were young. Eventually, we will reach the penalty.
Yeah, I think there's no question we could earn higher percentage returns working with $100,000 though than $10 billion. But it hasn't hurt us as much as we thought it would as size has increased. But your universe of opportunity shrinks. But it shrinks no matter. I mean, you can set it up in 20 bank accounts or one bank account, but the universe still has to fit the 10 billion in aggregate.
Mr. Buffett, I'm from West Point. My name is Rogers. A couple of months ago, there were stories in the World Herald that Berkshire Hathaway had taken a large position in Philip Morris and UST. But in your annual report, I don't see anything about that. Can you comment?
Yeah, I would say in the last 2 years, maybe, I'm just approximating, I've probably seen reports in either the Wall Street Journal, USA Today, maybe picked up by the Associated Press or in the Herald, but in papers of some significance, I've probably seen stories that we were buying maybe any one of 10 companies in aggregate over that period of time. I would say a significant majority were erroneous. We don't correct the erroneous ones because if we don't correct the erroneous ones, if we correct the erroneous ones and don't say anything about the correct ones, the correct ones too. So we will never comment on those stories, no matter how ridiculous they are. It's interesting because, they keep getting printed. And frankly, from our standpoint, the fact that most of them are inaccurate is probably useful to us. We don't do anything to encourage it, but the fact that people are reading that we are buying ABC or XYZ when we aren't, You know, I don't think people should be buying stocks because they're reading in the paper that we're buying something, but if they do, they may get cured of it at some point. Maybe the newspapers will even get cured of writing the stories when they don't know what the facts are. But it's something we live with and we'll probably continue to live with. And I would say that based on history, if you read something about us buying or selling something other than through reports we filed with the SEC or regulatory bodies, the chances are well over 50%. That I can tell you based on history is correct. Well over 50% that it's wrong. Zone 3.
Do you expect that Berkshire would become one of the Standard & Poor 500 stocks or a Dow Jones stock?
Well, I think it's unlikely it ever becomes a Dow Jones stock. I don't know what the criteria are for the S&P 500, but I imagine there's some reason why we don't fit. I don't know whether they have questions about number of shares outstanding, or I've never checked with S&P. I wouldn't be surprised if we have the largest market capitalization of any company that isn't in the S&P, although I don't know that. But they may have some criteria variety that preclude Berkshire being part of it. I've always thought it'd be very interesting for those of you who like to think about such things, that if we were part of the S&P 500 and enough people became indexed so that 60% of the market was indexed, and if Charlie and I wouldn't sell, which we wouldn't, it'd be an interesting proposition as to how the index funds would ever get their 60% if they tried to replicate the S&P. I don't know whether they have rules even about concentration of ownership. That same line of thinking might have applied to Walmart or some company, because just take the extreme example of a company that had 90% of its stock owned by one individual and 12% of the money in the market were indexed, and the 90% wouldn't sell it, would bring back the Northern Pacific corner or something of the sort. In any event, I don't think that's going to be a problem, and I don't think we are going to end up being in either index. Yeah, Zone 1.
Mr. Buffett, my name is Aaron Morris. I'm from California. What I wanted to know was how you think about how large a position you're willing to take in a given security, both in your case where you have new cash coming in that you can invest, and in a case of an investor where they have a fixed amount of capital and they're trying to decide what's the most they should put into security that they really love.
Well, Charlie and I have, probably at our present size, we will never find anything that we get as much money into as we want. I think that's probably true, Charlie, if we really like it.
Yeah, I think that's quite likely.
Yeah, so we will probably never hit the limit. We'd love to find something we felt that strongly about, and occasionally we do, but we won't get as much money into it as we would wish, or as if we were running $1 million of our own money or some number like that. So we are willing to put a lot of money into a single security. When I ran the partnership, the limit I got to was about 40% in a single stock. I think, Charlie, when you ran your partnership, you had more than 40%.
Sure.
And we would do the same thing if we were running smaller partnerships or our own capital were smaller and we were running that ourselves. Because now we're not going to do that unless we think we understand the business very well, and we think that the nature of the business, what we're paying for it, the people running it, and all of that lead up to virtually no risk. And but you find those things occasionally, and we would put, assuming it were that much more attractive than the second and third and fourth choices, we would put a big percentage of our net worth in it. We only advise you to do that. Probably don't advise you to do it at all, maybe, but we would only advise you to do it if you're doing it based on your own conclusions about your own ideas of value and something that you really feel you know enough to buy the whole business. If your funds were sufficient and was being offered to you, you ought to really understand the business. But people do that all the time, incidentally, in private businesses, which have got terrible prospects. I mean, they buy dry cleaning establishments or filling stations or whatever, and they put very high, or franchises of some kind, they put a very high percentage of their net worth into something that a business is very risky, basically. I mean, people put all their money in a farm. You know, it's a business. It's subject to all kinds of business risks. So it's not crazy if you understand the business well, and if the price is sufficiently attractive to put a very significant percentage of your net worth in. If you don't understand businesses, then you're better off diversifying and fairly widely diversifying. So, go ahead. Sorry.
Berkshire has a substantial shareholder whose father accumulated the original position, and when he died, he left a very large estate, practically all of which was in two securities, Berkshire and one other outstanding company. And a bank was co-trustee, and the bank trust officer said, "You've got to diversify this." And it was a very large estate. And the young man who was co-trustee with the bank said, "Well," he says, "you know, if my father had believed the way you do, he might have been a trust officer in a bank instead of leaving this large estate." And that young man holds the Berkshire to this day, and I suppose the bank is still giving the same advice.
Zone 2.
Mr. Buffett, I'm Barry Ziskin from Mesa, Arizona, longtime admirer of yours. Question pertains to Guinness. I remember reading in a publication I greatly respect, Outstanding Investor Digest by Henry Emerson in New York, that back in, I think it was 58 or 59, you made an investment in Cuba, decided never to make an investment outside the United States again at that time, have subsequently invested in Guinness. I'm a fellow investor in Guinness, have invested in Guinness and its sister company, Louis Vuitton Moet Hennessy, for over 5 years. And I'm very happy with those investments, by the way. There's been a restructuring, as you know, of the Guinness-LVMH relationship, where Guinness no longer owns 24% of LVMH, rather it owns only its distilling, or I should say, alcoholic beverage-related businesses.
The Moet Hennessy part.
Right, the Moet Hennessy part. The other parts of LVMH are showing better results these days, namely the Louis Vuitton luggage as well as the Christian Dior perfume. They've also expanded into the newspaper business this past year, business that you understand. Do you intend to look at the possibility, first of all, of participating in those businesses that you no longer own now with the restructured Guinness LVMH deal through some other form?
Well, LVMH, which as you mentioned was 24% owned by Guinness, you know, that's one of thousands of securities that we could be a buyer or seller. So I really don't want to comment on LVMH's specific attractiveness or lack thereof. And Guinness, I think what Guinness did was quite logical. I mean, their interest in that operation was basically through the distribution advantages that it gave to Guinness's own brands around the world to be hooked up with Moet Hennessy and vice versa. So I think what they did was logical. You can, the question of the exchange rate and all of that, the exchange rate in terms of what they got in the spirits business versus what they gave up in the luggage businesses and Christian Dior and a few things. You can form your own opinion on that. But I think the logic was sound. But in terms of whether we want to be an LVMH by itself, that's like any other security, which we really can't answer.
So the second part of the question is, do you intend to do anything about the currency risk portion of that investment?
Second question related to
hedging.
The hedging of
do
currency.
We hedge?
The answer to that is we don't. And Coca-Cola, as I mentioned, gets 80% of their earnings from a variety of currencies. The yen and the mark being two very important ones. They're going to be getting a very high percentage 5 years from now, 10 years from now. They do certain currency transactions, but it's a practical matter. If you own Coca-Cola, you own a bunch of foreign bonds with coupons on them, denominated in local currencies, that go on forever. Now, should you try and engage in currency swaps on all those coupons, you don't know what those coupons are yet because you don't know how much they're going to earn in Japan or Germany, but you do know it's going to go on for decades, and they're going to be very significant sums. Should you try and engage in a whole bunch of currency swaps to go on out and convert all that stream into dollars, we basically don't think it's worth it. We don't think our opinion on currencies is any good. We think the market probably we know it knows as much about it. It probably knows more about currencies, but we do not know more than the market does about currencies. So there are costs to hedging, and even though interest rate structures may cause the curve to look flat going out forward, so that in effect there's no contango on it, there's still the cost. There are costs in it. Now it's a relatively efficient market, so that they're not huge. But we see no reason to incur those costs with what we regard as totally a 50-50 proposition, and it really doesn't go out that far anyway. I mean, we could do it for a couple of years, but if you take the way we look at businesses being the discounted flow of future cash out between now and Judgment Day, we can't really hedge that kind of a risk anyway. We could keep rolling hedges, but there's a cost to it that we don't want to incur. We wouldn't worry a whole lot about whether some portion of our earnings, whether it's from Guinness, whether it's from Coke, whether it's from Gillette, are denominated in some mixture of marks and pounds and yen and dollars, or whether they're all in dollars. We'd slightly prefer it if it were all in dollars, but we don't lose sleep over the fact that it may be coming from a mix of currencies like that. We wouldn't like it in terms of, obviously, some very weak currencies. Zone 1.
Thank you. Sean Berry, Regina, Canada. Mr. Buffett, you've indicated that most of us in this room could acquire a lot of the information that you and Charlie acquire through the annual reports. Yet you both also indicated that the GAAP rules a lot of times leave a little to be desired. Could you perhaps give an indication as to how you and Charlie come up with the economic value or the intrinsic value of the businesses that you finally decide to invest in, and a little bit about the process that you go through with that? Thank you.
Well, in the 1992 annual report, we discussed that a fair amount, but the economic value of any asset essentially is the present value, the appropriate interest rate of all the future streams of cash going in or out of the business. And there are all kinds of businesses that Charlie and I don't think we have the faintest idea what that future stream will look like. And if we don't have the faintest idea what the future stream is going to look like, we don't have the faintest idea what it's worth now. So if you think you know what the price of a stock should be today, but you don't think you have any idea what the stream of cash will be over the next 20 years, you've got cognitive dissonance, I guess is what they call it. So we are looking for things where we feel fairly high degree of probability that we can come within a range of looking at those numbers out over a period of time, and then we discount them back. And we are more concerned with the certainty of those numbers than we are with getting the one that looks absolutely the cheapest, but based upon numbers that we don't have great confidence in. And that's basically what economic value is all about. The numbers in any accounting report mean nothing per se as to economic value. They are guidelines to tell you something about how to get at economic value. But they don't tell you anything. There are no answers in the financial statements. There are guidelines to enable you to figure out the answer. And to figure out that answer, you have to understand something about business. You don't have to understand a lot about mathematics. I mean, the math is not complicated. But you do have to understand something about the business. But that's the same thing you would do if you're going to buy an apartment house or a farm or any other small business you might be interested in. You would try to figure out what you are laying out currently and what you are likely to get back over time, and how certain you felt about getting it, and how it compared to other alternatives. That's all we do. We just do it with large businesses, basically. The accounting figures are very helpful to us in the sense that they generally guide us to what we should be thinking about, and of course, if we find numbers where it looks like people are taking the most optimistic interpretation of things that they can under GAAP and all of that, we get very worried about people who look like they massage the numbers in any way. And there are plenty of people that do. Zone 3.
I'm Howard Bascom from Kansas City. When you are estimating a growth rate on a company I'm at, of a very predictable company, I imagine you apply a big margin of safety to it. What kind of rate do you generally apply? I mean, high single digits?
In the margin of safety, or
what kind of growth rate would you, on a predictable company, might you
we are willing to
stab
buy
at?
companies that aren't going to grow at all.
Okay.
Assuming we get enough for our money when we do it. So we are not looking. We are looking at projecting numbers out as to what kind of cash we think we'll get back over time. But would you rather have a savings? If you're going to put $1 million in a savings account, would you rather have something that paid you 10% a year and never changed, or would you rather have something that paid you 2% a year and increased at 10% a year? Well, you can work out the math to answer those questions, but you can certainly have a situation where there's absolutely no growth in the business, and it's a much better investment than some company that's going to grow at very substantial rates, particularly if they're going to need capital in order to grow. There's a huge difference in the business that grows and requires a lot of capital to do so, and the business that grows and doesn't require capital. And I would say that generally financial analysts do not give adequate weight to the difference in those. In fact, it's amazing how little attention is paid to that. Believe me, if you're investing, you should pay a lot of attention to it. Charlie?
I agree with that, but it's fairly simple, but it's not so simple it can all be explained in one sentence.
Some of our best businesses that we own outright don't grow, but they throw off lots of money which we can use to buy something else, and therefore our capital is growing without physical growth being in the business. And we are much better off being in that kind of a situation than being in some business that itself is growing, but it takes up all the money in order to grow and doesn't produce that high returns as we go along. A lot of managements don't understand that very well, actually. Zone 1.
Pat Sadukhan from Houston, Texas. From time to time, you have quoted John Maynard Keynes, the British economist. So I would assume that you have read his investment writings very extensively. What are 2 or 3 investment lessons, in your opinion, one can learn from that economist?
Well, I forget which. I think it's chapter 8 of the General Theory. You remember, Charlie, or is it chapter? No. There's one chapter in the General Theory that relates to markets and the psychology of markets and the behavior of market participants and so on. That probably, aside from Ben Graham's 2 chapters, 8 and 20, in The Intelligent Investor, I think you'll find you get as much wisdom from reading that as anything written in investments, and you'll know it when you see it in the General Theory. It's a chapter that jumps out to you about securities and so on, and it could be chapter 8, but I may be wrong on that. But I would recommend reading that. Keynes and Graham, from vastly different starting points, came to the same conclusion at about the same time in the 30s as to the soundest way to invest over time. They differed some on their ideas on diversification. Keynes believed in diversifying far less than did Graham. But Keynes started off with the wrong theory, I would say, in the 20s, and he essentially tried to predict business cycles and markets, and then shifted to fundamental analysis of businesses in the 30s and did extremely well. And about the same time Graham was writing his first material, I think Janet Lowe in her book on Ben Graham actually has a little correspondence that took place between Keynes and Ben. So I would advise you to read that. And there's some letters of his of Keynes's that he wrote to co-trustees of life insurance societies and colleges and so on that I think you'd find interesting too. It's 1:15, and Charlie and I have to go to our directors meeting at Berkshire, which starts in about 15 minutes, so we thank you all for coming.